Welcome to our 2019 year-end planning for investors overview. This will be a three-part series on key tax planning opportunities. There are a few changes from last year's new tax form to the 2019 Form 1040. Most notable, the signature box is now on page 2. There is now space to enter the name of a spouse and children, and the healthcare coverage box is removed since it is no longer required. Also, there are now separate lines for Earned Income Credit, Additional Child Tax Credit, and the American Opportunity Credit. Income limits for all tax brackets are the same as 2018, however have been adjusted for inflation in 2019. Let's quickly review some key tax planning opportunities we'll be working on with you this year. I would like to focus on these three key year-end tax planning opportunities: tax harvesting of gains and losses, retirement plan funding, and gifting. Let's start with harvesting tax gains and losses. How do we use tax gain harvesting? Ideally, we try to sell assets with long-term capital gains in 2019 if you are able to take advantage of lower tax brackets. You can repurchase the same or similar assets. As an investor, a good rule is to always think about selling assets whenever you would have sold them otherwise. Gain harvesting. When should gains be harvested? For those with a very short time horizon, gain harvesting will almost always be favorable because of the benefit of tax deferral is so small. For those with a very long time horizon, gain harvesting will almost always be unfavorable because the benefit of tax deferral is large. And for taxpayers in the 0% long-term capital gains bracket in 2019, gain harvesting will always be favorable from a tax perspective because it gives you a free step up in basis. Now let's review loss harvesting. Loss harvesting is helpful to offset any capital gains so that you can potentially reduce your tax impact in your overall tax bill. Here's a key issue that investors need to be aware of, which is the wash sale rule. This rule basically states that in the case of any loss from any sale or other disposition of shares of stock or securities where it appears that within a period beginning 30 days before the date of such sale or disposition and ending 30 days after such date, the taxpayer has acquired or has entered into a contract or option so to acquire substantially identical stock or securities, then no deduction shall be allowed under Section 165. Here are loss harvesting strategies. You can sell your lost stock and buy stock of a similar company. For example, a taxpayer has a stock, for example, Coke, with an unrealized loss, which is also called the lost stock. That same taxpayer purchases a similar stock, for example, Pepsi, at any time prior to or after the sale of the lost stock. Note that the sale and purchase can occur on the same day and that the two stocks are not substantially identical. You can also double up on your lost stock and then wait 31 days. Thank you. We appreciate the opportunity to assist you with your financial needs. Check back soon for our next recording regarding retirement plan funding.